Greetings and welcome to Fool24, our daily live stream where Motley Fool members ask questions and engage with our team of investors across the globe. I'm Andy Cross, the Chief Investment Officer here at the Motley Fool. Thanks for being here with us. Today we're doing something pretty special, I think. We're bringing Fool24 to YouTube for the next hour. So here's how it will work, team. If you are a Motley Fool member watching this stream on Fool.com, your experience remains pretty much unchanged. But if you're watching this stream on YouTube, you can view the stream for the next hour. However, you won't be able to ask questions or engage with the analysts, that's us. If you're curious about where the questions are coming from, they're coming in live from Motley Fool members around the world via Fool.com. Now, if you love that show or this show, you can be one of those members and gain access to the entire stream and ask your questions. Just visit fool.com/invest to learn more. Now, a brief disclaimer before we get going. Fool24 is broadcast for educational purposes only. We can't provide personalized financial advice. And with that, let's get going. Joining me for the next hour is fellow investing analysts Asit Sharma and Matt Frankel. Fools, let's dive right in. Welcome to me, and thanks for joining me for this hour. Matt, you had a question that you thought we should start with. Go ahead.
Yeah, and to be fair, this one already was answered earlier today, but it's definitely worth spending some time on and getting some different perspectives on it. So I wanted to mention it.
Matt, that means you didn't think the first answer was good enough.
Well,
just kidding.
Was that my answer? No,
it was yours. Mine, probably.
And you're about to see. I honestly don't think any one answer is good enough for this question. Ed asks, if you are starting a portfolio today, what are the first 3 stocks you would have to have in your portfolio at today's prices? Now, I'm not a market timer. I don't look at prices necessarily when I'm buying a stock. I'm not saying valuation doesn't matter, but I don't like just go shopping, especially if I'm just starting from scratch. And I have to say, if I'm only going to pick 3, I would go kind of boring. I'm assuming ETFs don't count. So I'm going to do 3 individual stocks. My first one, I've written many times that if I can only own one individual stock, it would be Berkshire Hathaway. So that has to be in my top 3. Essentially, that's like buying a full investment portfolio in one stock. They have over 60 subsidiary businesses, a stock portfolio worth about $300 billion with about 40 different positions. Not to mention that $325 billion of cash they have sitting around. It's just, you can't really argue against putting Berkshire in your top 3 there. My number 2 would be Amazon, AMZN. It's really rare to find a combination of not one, but 2 different market-leading businesses in the same company, both of which have excellent growth potential. I've actually made a very bold prediction that Amazon's going to be the first $5 trillion company, and I stick with that. And number 3, this might surprise some people, is a company called Digital Realty Trust, DLR. They are one of the largest real estate owners in the world, and they specialize in data centers. So this would be my way to get a nice AI play without the AI volatility, I guess, if you will. Very well-run business, very nice track record of beating the market for over a decade. So yeah, those would be my 3, but I'm curious as to what you 2 think.
Asit, you want to go ahead?
Well, sure. First of all, I want to say that I agree with Matt. All those were great companies on the idea of Amazon as being in my basket of 3 stocks. I really like how well they're positioned for the AI future. I think that they're going to cross $1 trillion in sales in the near future, and they're going to wreak some more operational margin out of all those sales. Amazon Web Services has shown such a nice momentum after hitting this sort of roadblock where companies were optimizing their cloud spend. With the explosion in generative AI, Amazon is reaping some advantages through its deep infrastructure, and it's designing its own chips. I could keep going on about Amazon, so I'll leave it there. I would go with another large cap company that I like very much, and this also is consonant with Matt's idea that, okay, I'm not that price sensitive. If I'm holding a company for a very long period of time, and I find a company that has the staying power, has the duration, has the competitive advantages, it's okay if I'm paying a slight premium today. So that company is ServiceNow for me. That's also a pretty large cap stock, Matt, but in a world where you say, look, some of these big guys are going to $5 trillion, then a company which is in the several $100 billion of market cap may still have some room to run. And I think ServiceNow is that company, great positioning in the enterprise, offering real AI solutions, generative AI solutions that are woven into the fabric of its ServiceNow platform to enterprise businesses. I really like this company. And the third, I'm going to hedge here, guys, because I have two big tech companies. So I'm looking for a type of company. I'm looking for a smaller company that's consumer facing, that embraces technology. Several companies come to mind. I may circle back, but I would say something in the vein of a Lululemon or a Spotify could sort of fit that mold for me. Andy, what about you?
Yeah, I guess it also depends on what you're thinking about. Are these foundational cornerstone stocks? And so that's kind of the way I went through it, as if you were building out a portfolio. And we do this over at Stock Advisor, just help provide guidance around like real foundational stocks. And so just thinking about some of those businesses like that, I think Meta has clearly demonstrated they have a leadership in both advertising along with Google. They have more than 3 billion users across all their properties. They're leveraging AI. They're spending gobs of money, but they're starting to see that return on that. And I'm very impressed in kind of how they manage that, and also clearly manage the year of efficiency that Zuckerberg put them into. Vertex Pharmaceuticals is a pharmaceutical company that has a near monopoly on a drug that helps with cystic fibrosis, but they also have an attractive pipeline that they're starting to build out, and the stock is very reasonably priced, I think. I think just after concerns of how lasting is the Trikafta drug to be able to that franchise, considering that, you know, patent expirations and all that. But I think the model's sound. I think the balance sheet is healthy. I think they have a leadership team that can continue to expand into other solutions as they've recently proven in. And then my third one, I'll say Mercado Libre. So we talked Amazon. I think Mercado Libre, international growth, the leader in both e-commerce, as well as more and more commerce, both offline and online. They have a really growing payments business. Their finance business is attractive. They're making investments into logistics. They're continuing to build out that moat. So for me, Mercado Libre, MELI, Vertex, VRTX, Vertex Pharmaceuticals, and Meta, META. Those are my three that I think would be great ones to start with. But I like, certainly can't argue with the three that you all mentioned as well, too.
Awesome. Let's see.
Hey, Matt asked a question about Roku. Matt says, Mr. Frankel, is Roku a criminal offender with the stock-based compensation that's currently playing out? So Roku, I think, is in a very interesting spot when I just think about the ad market, and also to jump in here as well, too. The connected TV, the online ad market, I talked about this. We talked about this in some earlier shows. You know, they continue to see more and more usage across their platforms. It's really a monetization game. The challenge is making sure the cost structure reflects the business. And like many companies, they do pay out a lot in stock-based compensation, and that ultimately goes against earnings. Now, on the cash flow side, when you look at cash flow, if you add back that stock-based compensation, it makes the cash flow look a little bit attractive. But that is a real expense, and you have to account for that for that expense. But so I think I don't know if I wouldn't say it's criminal in any mean, but it is high. And I would like to see them continue to pare that down. But I think Roku starts to enter a little bit of an interesting positioning in their leadership position with connected TV.
Yeah, I don't know when I became the stock-based compensation police, but apparently I have over the past year or so. There are a bunch of offenders, and some are in my portfolio. I'm not that familiar with Roku's, but Roblox is an example that has roughly $1 billion of stock-based comp a year.
Yeah.
And I mean, until recently, they were about a $20 billion company.
Well, and Matt, just that for some context, that's about, last time I checked, that was about 33 or 34% of their revenues.
Yes.
Were going into stock-based compensation, which is far higher than I think you'll see from a lot of other tech companies, even those that pay it out.
Yeah, and I'm not necessarily against stock-based comp. I feel like it needs to be acknowledged a lot more than a lot of companies do, if that makes sense. Like, it needs to be an acknowledged part of the earnings. Yes, it's not a cash charge, but it's still a cost. It's still dilution. If you're paying, 5% of your market cap in stock-based comp, that's a pretty high hurdle just to break even, just to offset that dilution. So it's not that it's a criminal offender. Roku hasn't had fantastic growth over the past few years, so that's more of what makes them a stock-based comp offender. A company like Roblox that's growing 30-40% year over year, that's paying $1 billion in stock-based comp, I'm more okay with that.
Yeah, those are all great points, Matt. I really like the idea of management discussing stock-based compensation when it's high, acknowledging it, as you said. I like management teams that also are sort of transparent and say, okay, we're going to push the pedal a little more on this. We want to incentivize some of the engineers we're hiring so it actually may go up, or we want to control it somewhat. We're going to bring it down to a manageable level of sales, X%, or perhaps we're going to buy back some shares to offset some of this dilution. Companies that are serial offenders in this nature and keep raising it without context, that makes me really want to, take a fine magnifying glass to the results. And sometimes you find that it's fine. Like a company is crushing it on every conceivable metric. Let them continue to compensate their key people so that they keep winning. I'll take that dilution as a shareholder in those cases.
Yeah, the concern is that they have to buy back lots of stock to offset the dilution, right? As you said, Austin. So that's just the thing. Then the free cash flow doesn't really necessarily go always to the shareholders. It goes back to the company, right?
That's true. And everything's relative. So some companies have extremely generous cash flows, and it doesn't hurt the balance sheet. At the end of the day, you still have money falling to the balance sheet. But in other cases, Andy, you're right. Like then, and in some cases, it's money that could have been better invested in the business itself. And that always hurts to see as a shareholder.
Yeah.
You guys want to do the Amex question, Andy?
Sure. Yeah, let's do that, Matt.
Yeah, I see this. It was from a day ago, but it's one of my favorite companies to talk about. What is your opinion? This is from Ron H. What is your opinion on Amex, AXP? So I recently wrote an article, and after I'm done talking, I'll go ahead and throw it in Slido about how Amex was one of the first stocks I bought when I started to buy individual stocks. This was shortly after I started working at the Fool. I learned while I earned for a while before I actually put a lot of money into the market. But Amex was one of the first 4 stocks I ever bought. And out of those 4, it's one of 2 that I still own. I've never sold a share. My position's grown from dividend reinvestment. And the stock itself is up 264% as of right now since I bought it just over 10 years ago. So the things I love about Amex, one, it's done a great job of just adapting to changing conditions. You would have thought, if I told you I bought Amex in 2014, they were dropped by Costco in 2016, which at the time was 20% of their total credit card loans.
Mm-hmm.
You would have thought that was a death blow to them. But no, they did a great job of pivoting. They doubled down on some of their more successful and more lucrative in-house products, specifically the Platinum card. That was a big success for them.
Yeah.
They created a lot of benefits that really embraced the millennial and Gen Z crowd. They realized, hey, these are going to be our customers in 2040, 2050, and 2060. We need to really do a good job of embracing them now. They built out their online banking platform really impressively, and they keep refreshing things. They did 40 different product refreshes in 2024 alone. So I just really think that they've done a great job of just rolling with the punches. Nothing incredible. I mean, it's been about a 250% return in 10 years. Not incredible, but just a great compounder. And I think I have no reason to get rid of it.
Does that include the dividend, Matt, that return?
Yes.
Yeah. So it just pays that dividend. This is Matt, or Asad, Matt, when Matt mentioned this, talking about this question, I just said to him, we had looked at this. I had looked at this maybe, 18, 24 months ago and knew the story. And I've been an Amex user for 20 years or so. And the stock in 2024 has had just a magnificent run for all the reasons that Matt had mentioned. It is one of those compounders. When you find those compounders that are kind of lull, and 2022, 23 kind of had this lull, you picking those things up at 16, 17, 18 times earnings, and you can see when they do deliver how that can react into the stock price.
Yeah, Andy, I'll tell you something that tripped me up about Amex, and I think it trips a lot of investors up, is that you start grouping it with MasterCard and Visa, looking at the 3 of those together, and trying to decide, okay, which one of these would I own? And Amex has a different business model. It's not quite structured the same as MasterCard and Visa. It is a charge network, but it makes its money in a very different way. It has a lot of affiliate revenue that it tends to hit the bottom line. So I think I've been thrown off in the past by lumping 2 businesses that are very close together with a third that isn't quite the same, and just looking at the advantages that MasterCard and Visa have versus the risk reward scenario, and over focusing on those two. Now, I think an investor can own all three and do well. And so I think from my own perspective, I also missed out a little bit on American Express. It performed very nicely over the last year to 2 years.
Matt, does the Discover potential likely acquisition by Capital One and that network, does that further solidify the value of the Amex network, or is it a competitive threat? How do you see that?
Well, I would say one thing I would note is that Amex is on a completely different plane from other credit card issuers when it comes to asset quality. Just for example, Amex right now has a 1.9% charge-off rate. Capital One, which is acquiring Discover, has 5.6%. So, completely different plane when it comes to asset quality. But Discover is probably Amex's closest competitor in terms of business model, in terms that it's a closed loop payment network. But like I said, it completely different product suite, different clientele. I don't really view that as a big competitive threat to Amex. Capital One's tried several times to attack the high end of the credit card market, and it hasn't had nearly the success of Amex. So they play in different arenas, I would say is my best answer to that.
Jimbo asked a question about Manhattan Associates, MANH. So this is a hardware company, but really software, logistics, warehousing software. It helps retailers and other clients with their warehousing and logistics. And the stock and the business had done very well. It's actually a really very good business, exceptionally profitable, very healthy returns on capital. The stock got really hammered after they announced earnings within the last week or so. And the guidance for the year had really pulled back. And the reason the guidance had really pulled back is primarily for their professional services. So they still have about 80% of their clients are still on traditional, more on-premise services and solutions rather than in the cloud. And so they are migrating a lot of customers still to the cloud. I'm still always amazed about how much room opportunity has for companies to move into the cloud, especially ones that have been operating for so long and may have very familiar solutions on premises. But as these clients have their software solutions, that comes with professional services, consulting kind of fees, and that is slowing down this year. They had expected about 10% of their clients that have active kind of new installations are not going to be using the professional services. And so that is really hurting the growth rate going into this year. And they actually think revenues are going to be up in the low single digits and earnings are actually going to be flat or down. So that clearly hit the stock. Now the positive news and besides being so well run, financially stable, very high returns on capital, all that great stuff you love to see from a company, is that the cloud business continues to grow nicely, and they expect long term that's like 20% kind of levels of growth. But they have to get back on that growth pattern team. And when you have a business that the stock had done so well, the expectations baked into it, you see a really visceral reaction from the markets when the management team comes out and says, "Hey, 25 is facing some headwinds for us, and this is what we're seeing."
I'll just add to that really briefly. So, Jimbo, I am scheduled with a great Fool contributor, Jeremy Bowman, to do a deep dive in our deep dive series on Manhattan Associates. So look forward to that on the schedule. It'll be coming up in the next few weeks.
Oh, good. Looking forward to that, Austin. Thank you for doing that.
Yeah. So I don't know Manhattan as well enough, so I'm just going to move to a different one.
Yeah, go ahead. We got so many great questions coming in. Thank you for those questions. So let's just roll through them.
Yeah. I just lost my whole feed right there. Reread said, Matt, when you figure your portfolio allocations and diversifications, do you consider REITs as part of your stock allocation or another part of your allocation? I generally consider them as stocks with a big asterisk. Real estate generally doesn't perfectly correlate with stock investments over time. I'm generally known as the REIT investor. Sorry to you guys, because you're going to get a bunch of REIT questions come in on the chat while I'm on the show. I know we haven't done one in a while together, but that's just how it goes. So when it comes to diversification, I definitely try to limit my exposure to REITs. I'd have to really actively limit myself just because I consider it my core competence and I invest in it a lot. Much like how, some other people you probably see on these shows probably invest a lot in AI stocks, or, have a disproportionate amount of their portfolio in those. So I do have to actively limit my positions, but generally I consider them as stocks. A lot of people say real estate's a totally different asset class, and it is if you're talking about maybe buying an investment property or something like that. You need to know the dynamics of REITs and how they move with interest rates, unlike other stocks and things like that. But I don't necessarily consider real estate investment trust to be a totally different asset class. And let me find another one.
Matt had asked, of all the companies who report earnings after the bell this afternoon, Google, Chipotle, AMD, FICO, PayPal already reported, and their PayPal's numbers, while the quarter was actually pretty strong, I think there's just a sense of the efficiency gains that Alice, Chris, and his team, we talked about this on the morning show earlier this morning, have benefited. We didn't quite see that, and maybe even the guidance was still fairly healthy. We didn't see that this quarter. So I think just some concerns on their operating foundation, because PayPal is relatively more of a muted growth story now, so it really is trying to get as much efficiency as possible as they continue to grow both their 430 plus million members and transaction usage and balance between the commercial side, the B2B side, the white label side, some of it white labeled, and the peer-to-peer side, and figuring out how to be more and more relevant and larger. I think they will be. It's just that it's now such a competitive space. You saw people saw the announcement with Visa and X partnering together for peer-to-peer network money passing. So it's a very competitive space. So it's really on that efficiency. And even though they announced a $15 billion buyback, which I'm excited as a shareholder, excited to see. I think that's what has unnerved the markets a little bit today, and the stock has done very well through this year, and kudos to that team. But I think of those, I guess Chipotle. I think I'm excited to see Chipotle new to leadership as Brian Niccol leaves to go over to run Starbucks. I think they now officially promoted the leadership team internally. So I just want to hear what they are saying to continue to drive the Chipotle growth story. How about you all? Anything in there in that list? Google, Chipotle, AMD, FICO?
I'm curious about. Go ahead, Matt.
No, I was going to say, for me, it's probably Google. I love Chipotle. Actually, the first article I ever wrote for the Motley Fool in 2012 was about Chipotle. So, long relationship with that stock. One of the worst investment decisions in history was McDonald's selling Chipotle for $6 million.
Yeah.
Or whatever it was. But for me, it's Google. I already mentioned I'm a big Amazon shareholder, and for a lot of the same reasons that I like Google. It's two dominant businesses, not dominant with Google Cloud, but two leading businesses almost. I think Google Cloud has a lot more potential than a lot of people think, and just the economics of Alphabet's business are just fantastic. It's got margins that would pretty much make any other tech company envious. And it's like Amazon with better margins in a way, in terms of its dominant business.
I'm interested to see how FICO's going to perform this quarter. The company has had such a run up. Andy, we've talked about this before.
Yeah.
Just curious to see how those results look. Maybe we get a little bit of multiple adjustment if it doesn't meet expectations. But it is a very strong business and proved itself to be such an amazing brand over the last few years during the COVID stretch and into the realm of higher interest rates. Rather than losing relevance, FICO seems to have gained a lot of resonance and relevance with different companies that use its scores. And I do think that there is something when we look at capital markets, regardless who comes along, Upstart is most commonly cited competitor to offer up credit ratings and credit assessments, credit profiles. There is something in the capital markets, some degree of trust to FICO's data. You'll see this in roll-ups, tranches of financial loans. So I think many people underestimated its staying power and its brand power, but I feel like it's vulnerable at different earnings reports to come back down to earth just a bit. And I'm looking forward to AMD's results as well. I think it's been a challenging year for AMD the stock, but it was a pretty solid year for AMD the business in 2024. And I'm curious to see of all the routes it has to win, what is going to provide the promise for the rest of this year. Either it's going to be a combination of GPU sales and some of the things that they're doing with devices. So creating NPUs, neural processing units, different types of configurations where we can run more AI on device, or some of the basic building blocks of its business, the FPGAs and other types of esoteric chips that it just seems to keep selling more of. And I'll point out before I wrap this one up that while all the attention's been on AMD's GPU business and how it can compete with NVIDIA, it's done a lot this year just with the CPU business. It overtook Intel in the data center as the leading supplier of CPUs for AI workloads. So a lot to look for in that report. Let's see what happens. The stock is beaten down. We may have another downside surprise, or we could see the opposite happen today.
I don't know how many real estate questions you guys want me to take. But...
Well, go for it. Take that one. Take that one you're looking at.
I do see a quick comment I see from Matt. It says, Mr. Frankel. He calls me Mr. Frankel because he's named Matt too. You can't just say, hey, Matt. Once they report all fourth quarter earnings, I'd like to see you and Rick Munarriz do another Motley Fool sponsored YouTube video about the cruise stocks. Every time cruising comes up on a show I'm with other people, the big reaction, I would never get on a boat. So, and Rick is the only one who doesn't say that. So I'll be sure to pass that along to Rick. I'm sure we will do that. I don't know if either of you follow the cruise industry at all.
No, I don't. I did a couple hours with Rick recently, and we were just talking about the cruise market, which I think the predominant theme from that conversation was just how the cruises have, very much like the airlines, started to get some real, I think coming out of COVID, some pricing discipline. But you clearly see what Disney is investing into their cruise lines. You see Viking cruises going public. And so there is something there. And, whether it's aging population looking for alternative ways to spend money, like with Viking Cruise, which specializes in river cruises, or, as Rick was saying, with some of the others, really trying to tailor their experiences for families, young, old families, to be able to, and I think they've just gotten some real discipline behind that. So I don't own any of the cruise lines, but that's just something that I've watched with and applauded with. Anytime those businesses can get real discipline around that, I think that's a good thing for commerce.
Good.
Yeah, just to follow up, I almost feel like the cruise industry is too difficult for me to be able to invest successfully in, because it is, as you point out, and it's like the airline industry. So you have these very, very high hurdles of capital commitment. Cruise ships equivalent to airplanes. Then you've got the load factor. You've got to get people on those ships and utilize the ships. And then you've got, one-off events that can throw your business model. You have to leverage up your balance sheet to build more capacity, because you need more capacity for more revenue. To me, that's extremely difficult. I mean, it's so hard to invest. I know that some people are very successful at this, but they're patient too. They wait for the right time to buy an airline stock or a cruise company. Typically when, they've had some kind of hurdle in their business, that's really is the best time to buy these. They're different in that respect than some other industries where sometimes price doesn't matter as much. You'll pay a premium for a company which has a growth story and low capital commitments, but it is so much fun to study. Just studying the cruise industry makes you want to take a vacation.
Yeah, I mean, that's what we try to do. We try to study lots of different industries and businesses just to kind of understand them better.
For me, the most impressive thing about the cruise industry, I mean, and I'm an avid cruiser, but the most impressive thing is just the staying power it's had in the post-pandemic surge. When you look at, say, you mentioned Disney, Andy, Walt Disney World, massive surge when the reopening happened in 2022-ish, that area. That was their best year ever. People were spending money. The parks were packed. Then it kind of tapered off. Now, when Bob Iger came back, he acknowledged that their pricing had gone too far the other way. It was turning off people and things like that.
Yeah.
The cruise lines haven't had that problem.
Yeah.
It's been bigger, more expensive, better, more things to do, more things to spend money on the ships. And it's just been really impressive staying power. Like here we are essentially 3 years after the big reopening. And they're as busy as ever. So
Yeah.
that's what's really been impressive to me.
Uh, Jimbo had a question. What are the tariff impacts on EME, Elf, Boot, Celsius, Warby Parker, WRBY? And team, I wanted to just broaden that question out maybe to each of you and just think about, just how are you thinking about tariffs in general impacting certain stocks of the portfolio on a scale of 1 to 10? Is it a 0? I'm not really even thinking about it. It all comes in the wash. 10, no, I'm laser focused understanding companies that are deeply impacted by potential tariffs, whether they're either impacted from or put on by the United States or in retaliation put on from other companies.
Yeah, so for me, it's a 6. And I should say that Monday it was like a 7 or an 8 because it looked like we had very imminent tariffs that were coming and going to hit North American supply chains, et cetera. But I'm still paying attention because China didn't get an exclusion and they had some retaliatory tariffs. I spent some time in the cloud industry, the semiconductor industry, and that has an effect there. So to put this in perspective, though, nothing overnight. I mean, I'm not going to make any decisions on any kind of tariffs until I see a quarter or two of results where management is discussing how they're going to react to, let's say, elevated raw materials costs or prohibitions on what they can export, what the plan is. I think that's a better way to go about it than what most of us had, this initial reaction, which is, wow, the market is way down. I wonder what's going on with my companies. We've been through this before, 4 years ago in the previous Trump administration. And I think we all learned from that tariffs take a little bit of time to work their way through the system. And you have time as an investor to evaluate the impacts and make any decisions you need to.
Matt?
Yeah, I mean, for tariffs, I would take everything with a big grain of salt. And I'm personally looking for buying opportunities right now in the market that with just one big example, home builders. One of my favorite companies is Dreamfinders Homes. That's one of my largest stock investments.
DFH.
Yep. I believe that's number 5 in my portfolio right now. It's a company I really love. I love the management. They took a big hit on Monday morning when tariffs were going into effect. And it was really tough to figure out why. And it's because all of their lumber comes from Canada.
Yeah.
So the kind of sneaky tariff plays like that are where I'm really trying to pick up, and as far as just kind of like don't blow things out of proportion. Prices aren't going to go up quite as much as you might think, even if tariffs go into effect. One great example I read before we came on here, let's say you wanted to go buy a case of Corona, which is imported from Mexico. The actual cost of that product would be roughly 5% higher if that 25% tariff were passed on, because that's only on the wholesale cost of bringing that into the country. It wouldn't need a 25% markup. The markups you're going to see on the shelves and things like that, and the actual impact on sales are not a 25% increase or anything like that people need to know. So, short answer is that I'm really looking for opportunities in kind of sneaky tariff plays and ones that where people think that the effects are going to be a whole lot more than they actually might be.
Yeah, I'm probably in the 3 to 4 range. I think they kind of wash their way through and how it kind of all impacts the various companies, how the companies either pass prices on, absorb margins, get more efficient. But clearly margins are important for the market. The market has to continue to grow for the market multiple to be earned. So those margins are important. But I think overall, companies have just really been, especially large companies, like a company like Walmart or Amazon, they become so much efficient in their supply chains. So I don't worry overly too much. It does get me interested in supply chains in general and who's going to win from that spot. And like you mentioned housing, Matt, I think a company that I've not bought into yet, but I think is interesting is Trex, TREX, the deck composite maker, because they source so much internally in the United States from recycled products, plastic bags and that kind of stuff. And then they have plants and facilities that turn that into their composite decks. And it's really done primarily here in the United States. And so that worry isn't so much, and they sell a lot in the United States. The bigger worry for Trex is just what is the housing market in general, both both new builds as well as renovations. And right now, Matt, as you mentioned, that's just a little bit of a struggle for the market.
Yeah, and I totally forgot to give a number. I'd say I'm at like a 3 or a 4
Yeah.
as well.
Okay.
Forgot that part of the answer. Let's see. I see a couple of real estate questions, but like I said, I don't want to, bogart the time with all the REIT questions.
No, go ahead. And then maybe do take a REIT question. Then Asa, maybe we can look at that Howmet question. If you saw there's a Howmet question in there, or I can just say it.
Yep.
So take a REIT question, then we'll talk Howmet.
Awesome. I love that we're in like totally different wheelhouses. That's kind of nice.
Yeah, I don't
John,
think I don't really, I don't dabble much in REITs.
yeah, I kind of, I guess carved out a little niche there.
Hey, there's nothing wrong. There's not.
Live.
Hey, we are. Yeah, we're trying to help the world invest better. So that encapsulates lots of different parts of the market.
One of my biggest accomplishments on original Fool Live was getting one of our tech focus hosts, Brian Withers, to buy his first real estate investment trust.
That's a win.
It's always
because
a
of our
leap
show.
for a tech focused investor.
John Gallegos says, Matt, Andy, and Asset, good afternoon from sunny Arizona. It is beautiful in South Carolina as well. It was 12 degrees about a week ago, and now it is 78. So
that's a win.
do you see REITs doing better later in the year once additional rate cuts occur? If so, is it a buying opportunity? The short answer is yes. So real estate investment trusts are some of the most rate sensitive stocks in the market. It's pretty much every sector underperformed in 2022, right? That was the big bear market.
Yeah.
But in 2023, real estate dramatically underperformed. I think it was actually down for the year, while the S&P 500 was up like 30%. And the reason was because while the economy could, rebounded nicely in 2023, interest rates continued to rise rapidly. And that really weighed on real estate investment trust. There's a couple really good reasons for that. One, rising interest rates put pressure on commercial real estate values. So the underlying properties are worth less to investors who expect a certain yield from their investments. Number two, real estate investment trusts use borrowed money to fund their growth, just in the way that you or I would use a mortgage to buy a home. Higher interest rates means higher borrowing costs. It's less easy to make money from using borrowed money. So the short answer is yes. If we do get further interest rate cuts this year, more than the one, it's about 1.5 that are priced into the market right now. For the rest of the year. If we get more than that, it's definitely a positive for REITs. If we get fewer than that, you'll see real estate underperform again. But that's a big if. No one knows for sure. Who at the beginning of 2022 would have thought interest rates would do what they did that year? Mm-hmm. We could get 6 interest rate cuts this year. We could see interest rates rise if the wrong economic storm happens. So I would say yes. I see some long-term buying opportunities. I don't want to say that REITs are going to have a great 2025 because of interest rate cuts, but I do see a lot. I see another question mentioned Realty Income, ticker symbol O. That's the biggest real estate holding I have. There's a few other ones. Prologis is one that's really attractive right now. PLD. Mm-hmm. The biggest real estate owner in the world.
Warehouses, right? PLD warehouses.
They have 1.3 billion square feet of space. I don't know if you can even fathom how big that is. But there's a lot of opportunity in real estate long term, because I think right now the long term interest rate is going to go down. But I don't know if it's going to happen in 2025 or not at this point.
Yeah, thanks for that, Matt. Also, you want to talk maybe a little bit of Howmet, HWM, not probably well followed or owned by whether members watching or our audience out there on YouTube. But Andy, Asa, any thoughts on how on HWM Aerospace, Defense, and Industrial Gas Turbine components for AI energy, alternative defense stocks, U.S. rebuilding strength? So Gordon asked all just kind of about Howmet and HWM. You want to give a few comments on that?
Sure. So Howmet Aerospace is a stock advisor recommendation. It is, as Andy says, not a household name, but it has a specialization in some really interesting parts of the aerospace industry. This is a company which for decades specialized different alloys, from aluminum alloys to titanium alloys, and now supplies over 90% of the moving aero parts in jet engines. It's really a niche player. So speaking of niche businesses, Matt, like your knowledge of REITs You can think of Howmet as a niche player in the aerospace industry, but it's on both the commercial and the defense side, as Gordon notes. So while it really is in the business of supplying parts for jet engines, it has a couple of other interesting potential tailwind type businesses that it's engaged in. Now, one we've spoken about before on Stock Advisor. This is a business in supplying aluminum wheels to the trucking industry that are themselves specialized in their alloys. But the other is supplying blades to the industrial gas turbine engines that will be the intermediate step between how the grid is powering data centers today and the nuclear power that may be 7 to 10 years away. For those of you who follow this industry, the small modular nuclear reactors. So some of the largest companies in the world which supply these IGTs to data centers and are working with big builders like Amazon Web Services and Microsoft Azure right now to power data centers as they're being built out over the next 5 years are going to need the full slate of components and blades. And this company, Howmet Aerospace, happens to be the preeminent supplier of the blades for these IGTs to companies like GE Vernova, Siemens, etc. So this is sort of a nice little niche on niche business that we picked up on when we were researching the company, and Andy and I and Emily, who make the decisions on the side of a Stock Advisor scorecard, really find that attractive. It's not something that's really factored into the price of the stock today. I think the earliest indications that this will be material to the financials will be 2026. This is kind of the long-term tailwind that we're attracted to. Things like this give a thesis a little bit of an edge that makes you favor companies if you're a long-term patient shareholder in industries like this, where the premiums aren't super high and the price to get into a company, a business like this.
Well, yeah, I mean, it's what I liked about it as we studied more and more about Howmet is just the diversification of different industries, and you just walk through a few of them, including some of the effectiveness of how they may benefit from helping a little bit more of some of the alternative energies, some of the more green space in the products they serve. So aerospace and defense is going to continue to grow. That's why companies like TransDigm, as we talked about, have done so well, and HEICO also, both part suppliers and others. But Howmet has a little bit more of that diversified stream, which I like to see as well too. Roberto asked, do you think that, I think he's asked this a couple of times, Roberto, so let's try to get some answers here. Do you all three think the tailwinds may soon extend from the AI chips like NVIDIA also to AI-based software? So companies like Vive, SOUN, which I think is not Sound United, SoundHound, right? SoundHound, and CRM, which is Salesforce, becoming big winners thanks from Italy. Well, Roberto, thank you for chiming in from over in Italy. I do think that we will see, I think you saw this reaction during the DeepSeek news team, is that when with so much of the hardware companies, the NVIDIAs and some of those downstream, or I guess maybe upstream providers, the picks and shovels, and you saw some of the downstream users like Apple was actually up for that day. And I think the benefit there is, it doesn't matter how the AI and the LLMs are generated, cheaper cost means better news for the users, including many consumers, of more and more models to be able to pick from, and then the clients be able to use those models for their own clients. So I think those downstream providers are very attractive. Salesforce is already a very large company. I think Viva Systems, which is a customer a CRM tool really for the pharmaceutical market, which the stock long term has done well, but it's kind of just stagnated over the last couple of years. I think they are in a position to benefit as well, especially as they build out their own CRM tool, the Viva Vault, and diversify away from using Salesforce. I don't I don't know SOUN as well, but I do think those downstream, the beneficiaries of using AI tools, will benefit as the LLMs and the models become a little bit more, I don't want to say commoditized, even though I know Satya Nadella used that term in Microsoft, but as they become cheaper and more widely available to clients, to users.
I agree with that, Andy. For a company like Viva Systems, which is, we thought a couple of years ago might be late to the AI game, but they've really invested in AI. When you can bring compute costs down substantially, the DeepSeek model gave us a glimpse of that. And I know there's some dispute on how much they actually spent, what the upfront costs really were. But for those of you who've had a chance to read the paper that they put out and see the gains they're making, there's a sort of a blueprint there for other model makers to follow to see some compute efficiencies. That's the difference for a company like Viva in green lighting, maybe another outward-facing, customer-facing application. When you can take a project that may be $10 to $15 million and that become, I don't know, let's say a $5 to $8 million project within the company, there's a higher percentage chance of it getting green lighted, and we get the benefit of that. So I think this does, Andy, shift some of the power to the software side of the equation. I still think there's plenty of business on the hardware side.
And not surprising, right? That's what you would expect. You would expect that, right? Also, you would expect those to really benefit from. And I think this is when Goldman Sachs talks about the operating profit improvement over the next 3 to 5 years of, well, maybe over the next few years of, I think it was somewhere between 300 and 500 basis points in operating margin. So the operating profit companies get divided by the revenues they bring in. Obviously, the higher that is, the more profitable they are. And if they can do that and use AI tools to be more efficient, if the cost of those AI tools are going down and they are benefiting that as they are implementing them into their systems, as we're starting to see the likes of Salesforce do, although they have their own LL model as well too, and others, that's just going to be a beneficiary of operating margins, ideally, if assuming that business continues to grow. And that's going to be, as we know, earnings are really the driver of stock prices. That's going to be good for the markets. And a lot of that, by the way, I think is priced in. Those expectations, Osset, are somewhat priced in. But so it's not surprising to see it. And even Sam Altman, I think, had mentioned, it's not surprising that DeepSeek did this. Maybe they were surprised at who did it and that it came from over there and they didn't do that themselves. But I think they were like, that was the direction that the market is gonna move. And so that is going to be beneficial, I believe, for a lot of those providers. And I think Vive and CRM certainly are going to benefit from that.
Yeah, I don't have too much to add for AI software. In the words of Charlie Munger, I have nothing to add there. But I will say that a lot of what you said are the same reasons that I like to play the data center space as my big AI play. Because a rising tide is going to lift all ships there, and it's going to trickle down from the chip makers to the software makers, all of whom are going to need more data center space. I don't really have to care who wins. It's like investing in Visa instead of investing in any of the merchants that use Visa. It's no matter who wins, they're gonna be all right. And Digital Realty is my favorite play there. Equinix is another great one, and Iron Mountain is doing really really good things in data centers. They're kind of a sneaky data center play.
Yeah.
But I remember it wasn't that long ago that data centers were considered Jim Chanos's latest big short idea. That was just 2 years ago. And his whole rationale was that companies like Apple and Google and Microsoft were going to start bringing them in-house.
Yeah, do it themselves.
They don't want that capital expenditure. And then when AI hit, like the big AI revolution, they don't want to build data centers to the scale that's going to require in-house. So it's just a really kind of a rising tide lifts all ships type play, and I think the demand for data centers is going to last for a long, long time. So that's I don't know the software makers too much, but that's what I could add to an AI discussion.
Matt, did you say Prologis was it 1.3 billion square feet?
Yes.
Okay, so just for some comparison, just did some research here, popped it in some AI tools. So this is all coming from AI, not verified. But that is 1.3 billion square miles, is 1.5 times the size of Manhattan. Let's see, what else? Amazon has about 500 million square feet of warehouses, maybe?
Yeah, a lot of it's owned by Prologis.
Okay, so Prologis owns a lot. So the standard NFL football field is about 57,600 square feet. So you could fit about almost 23,000 football fields into Prologis' 1.3 billion square feet. So just some context about what that, when Matt talks about Prologis PLD and the size of their real estate footprint, gives you some context there.
Yeah, it's a massive company, and that size gives it some big advantages, not just the scale advantages that normally come with it, but it's one of like 4 or 5 different REITs that have A-rated credit.
Yeah.
They because they're worldwide, they can issue debt in whatever area they want to. They just issued $1.5 billion of debt at an average rate of 3.5%. I can't do that. I don't
That's
know
like,
if you could borrow at 3.5%. I can't.
Now I can't.
3 3/4, but not 3.5.
Yeah, Mr. Perfect credit score there. Blake asks, could you all discuss the recent price decreases in Elf? Is the lingering short report tariff concern valuation? To me, this looks like an attractive price. I think in general, yes. We haven't, Osset, really been super excited to add it to the top of our buy list, Elf Beauty. But clearly they source so much of their materials from China, or a good chunk of it. So there might be some lingering impacts there. The stock did so well. Again, a lot of these big drops are sometimes the business is okay. It's doing okay. It's just that sometimes, the valuation gets a little bit, kind of on the elevated side. And that's when, like, just like we're saying, not to the same degree with PayPal, but a little bit of just like some air coming out of the balloon, because momentum investors who expect quarterly continued acceleration of growth rates, if that starts to drop, that falls. But Elf also has some other things that it's working through too.
Yeah, I agree, Andy. We often see valuations get ahead of themselves when a company's results really start to shine. The growth hits another gear. That attracts all types of investors. We should draw a distinction between this and stocks that we would label, say, FOMO or hype stocks, which get really, really outsized premiums in a hurry without much of a business case beneath them. So Elf is not that. Elf is a very solid company. And I think there are still some lingering concerns over that short report. Likely also, as you mentioned, just some concerns over tariffs. Now, having said that, this is a company with a sort of a lock brand with the younger demographic who's concerned about the products that they're putting on their faces. And it's so popular among not just the I think Gen Zers, but even slightly older consumers. And it's so widely available. One of the key advantages of ELF, which I think many don't realize, has its distribution through Target, through Walmart. It's just ubiquitous. So it's a lower priced alternative. It purports to be a little bit better on your skin and have more of a sustainability bent. And this is, I think, one of the companies that if you're poking around and are looking for some candidates that could be now underappreciated by the market, almost feels like it's reaching that point. So,
yeah, I would definitely agree with that. I mean, I'm a pretty big fan of that business, and it's, I mean, 23 times forward earnings for a company that's growing 40% year over year. It's pretty impressive, and it's something I need to take a closer look at, honestly.
One of the 9 stocks we put in at the top of the hour, we did not include Microsoft. And Duffer at WD asked, Microsoft flatters for the last year compared to the other big cap boys. Thoughts on why? And I mean, I think part of it was just the business had been so successful on the AI and data center build out, leveraging those tools. They continue to struggle maybe a little bit on some of the on the computing side, personal computing side, that kind of thing. They had acquired the gaming company Activision Blizzard, have to bring that into the house, into the fold. I just think I think for a large cap company, and I kind of feel this way a little bit with Apple, but it just continued to impress. If you're paying 35 times earnings for a business that is kind of in the 10 to, I haven't seen the growth rates on the earnings side, but kind of in that range, Osset, like we haven't really aggressively promoted it as like as a top buying opportunity in a couple different services. I think just because some concerns around the size of the business and a little bit of the valuation, that's a battleship you got to move.
it is, Andy. And sometimes battleships are turning around in the water, and that takes some time. I definitely think Microsoft is in a build phase right now. There are actually three things you can trace to see how the future might be a little bit faster growth. I don't know if it's ever going to get back to like former rates of free cash flow growth, but can it accelerate from here a little bit? I think it can. So the investment in data centers, obviously, which is also true of Amazon Web Services, Alphabet, Oracle, etc. Number two, the introduction of their own chips, the Maya chip, which is going to be rolling out more and more production. So we'll give them some cheaper compute so they compete a little bit better on price. And then thirdly, the development of their own large language models. So, they hired an amazing AI scientist to work to form a group within Microsoft, even though they've invested so much in OpenAI and they're so tied up with the results of ChatGPT and its destiny. Satya Nadella isn't, taking any chances. He's hedging his bets, and I think we'll see, as we'll probably see at some point out of Apple, although that'll get more expressed on devices, some novel models that are coming out of Microsoft, which people aren't really focused on just now. So I think Microsoft has a few ways that it can accelerate its business in the next few years, but it definitely is feeling like it's in that reload phase where it's flattened out a bit. So there's some concerns around the margin about its growth, and hence the stock has been just a little bit stagnant over the last year or so.
Yeah, and they've done a great job with the LinkedIn business, and it's just like, and they will be a beneficiary of cheaper compute from being able to in throughout their 365 products. But it is just it's a very large company. You get the nice dividend, you add that in, right? Lots of share buybacks, but that's kind of the story. And I think those kind of come with a valuation bent you have to pay attention to as well too. We got a few minutes, team, before we turn it over for the next hour of Fool24. Again, thank you for joining us here, whether you're coming in from the YouTube audience or from our member base on Fool.com. Thank you for being here. Any other questions you all want to take as we kind of wrap up the hour here?
I'm going to super quick hit one that's actually not recommended. It's about a company that's not recommended in our Motley Fool universe, but it's interesting. Can anyone comment further on Astera Labs as a cloud and AI play? Just to say in general about some of these smaller players like Astera Labs, they're putting in parts and pieces which we haven't been paying as much attention to in the investment world. We've been so focused on GPUs. Astera Labs helps with esoteric stuff like making network connectivity happen quicker, data signal processing, so making sure the signal doesn't attenuate, it stays strong, so that's faster and more efficient. These little parts and pieces have growing demand in the data center space, and that's why if you've seen this little stock, it's done quite well. Now, it's very, very, very expensive stock right now, but I think it's a good example case for opportunities that may evolve in the investing landscape when we look at the complete end-to-end AI ecosystem from hardware, data centers, all the way to softwares. There is a role for these companies that are supplying just boring stuff that would put you to sleep if I described it to you, but is very much needed as we build out these data centers. So it's a fun company to watch.
Matt, anything you see you want to jump on to as we're wrapping up here?
Sure. I Need Input says, hey, Matt, curious why you like Dream Finders Homes better than Green Brick Partners, GRBK, which Tyler Crow likes a lot. I'd say it's because of where they operate and what they build. They're focused in the southeastern United States and a lot of the Sunbelt markets, and not just because I live here, but because they focus on some of the fastest growing and still kind of affordable housing markets in the nation. Depending on who you ask, we have a housing shortage in the U.S. of about 6 million homes right now, and roughly 1 million of those are estimated to be single family, with a big concentration on entry-level housing. People who want to buy homes but currently really can't afford to, or just interest rates are pricing them out, or things like that. Dream Finders specializes on entry-level homes in the more affordable markets, and I think as rates come down, they're going to be a big beneficiary of that.
Awesome. Matt Frankel, thank you for coming and bringing your thoughts. It's great to be on with you. I have a benefit of being on with Asset lots of different times and having very active conversations with him on lots of different stuff that we work on. So thank you both for joining us. Really a great hour. Really enjoyed that. And that's a wrap here for our Motley Fool Fool24 YouTube hour. Really thank you all for being here. We hope you enjoyed it and found it valuable. Now, if you're tuning in, like I said earlier, on YouTube from our YouTube audience and want to ask a question of our investors, head on over to fool.com/invest, fool.com Roku.com/invest to join the Motley Fool as a member. And if you're a Motley Fool premium member, well, stick around. We got another hour of Q&A right ahead with Bill Barker and Jeremy Bauman. Thanks so much for being here. Fool on.
Hold on, everyone.